Good afternoon, it's 2:36 p.m. This is Richard Posson, February 14th, Thursday, 2013. And this is just a brief sample of what we discuss in the Posson Report at our website at ag-financial.com. This is about the super cycles of the macro economy. And what I'm showing you is a line chart of annual nominal GDP per capita. And what I'm doing is labeling with the largest cycles and then breaking it down to the minor supercycle. In 1814, there was a peak for nominal GDP per capita. In 1813, I think there was a peak for inflation. 1812, I think there was a peak for the dollar. I might have those a little mixed up. But the stock market also had a significant peak. Now later the stock market recovered into a similar supercycle peak until 1835. There were a few other markets doing some flaky things that didn't peak to 1820s, but it appears for the most part, the significant peak for the economy was during the 1810s. The economy fell by 48% in terms of nominal GDP per capita into the 1820s. Now, the 1810s peak was a 216-year cycle. It actually spans about 180 to 230 years. So we use smaller cycles to try to zero in on that and reduce that amount of time to get it as close to pinpoint accuracy as we can. Now, with using hindsight, it's very easy. We just pick the most extreme high, and as long as it's in between the parameters of minimum maximum duration, then we can go ahead and just call that the cyclical top. Now, in theory, the 216-year cycle should have been down all the way to the 1930s, 1940s. I think I calculated 1940s was the latest for a bottom. As you can see, sometime in the 1850s, more so into the 1860s, nominal GDP per capita moved up and violated that 1810s high. So that immediately would have told the cycle series analysts, using a complete model of cycles breaking down to smaller and smaller cycles, would have told that analyst to drop down to smaller cycles, and those smaller cycles would have said be bullish regardless of the 216-year cycle, that it's not working. And I've studied this all the way back 1,000 years in a variety of commodities, history of economy, business, society, and I'm convinced that we're doing our best to reduce the impact of this true 100-year bear market that relates to the downside of a 216-year cycle. And you can see by the 1860s we had already conquered the Great Bear. With the Civil War, we got an explosion of nominal GDP per capita and some high inflation. And it actually peaked for a 54-year cycle. So the 216-year cycle is the major supercycle. The 54 is actually a major second. And then there's a 27-year cycle peak, which is the minor supercycle top. And you may recall that the 54-year cycle is also the famous Kondratiev cycle. Nominal GDP per capita then corrected through the carpetbagger area, the reconstruction after the Civil War, while the stock market actually did fairly well. And it declined by 38%, according to this calculation. This is a log chart, by the way, into a 72-year cycle bottom, rebounded to a 27-year cycle top, pulled back about 17%, and then went still higher to new record highs all the way into 1929, into another 54-year cycle top. It then collapsed 47%, nearly as severe as the 48% collapse from the 1810s. It collapsed in 1932 or 33 for a 216-year cycle bottom and the end of a 100-year bear market. Now we can see it really doesn't live up to the definition of a bear market during the 1800s. But what if it was like a running correction where the economy kept growing, that it was 100 years was too long for a downtrending economy, and what if the cycle was really just holding us back? We really weren't doing things correct well enough to really have the best economy we could possibly have. If that's the case, then usually you will see, if it's held back into some kind of cyclical bottom, you'll then see a speeding up. Well, look at this from the 216-year bottom. We now not only see a faster pace, I forget the percentages, but it's like it grew 10,000% or something, whereas it only grew 1,000% in the 1800s. Not only a faster pace, but look at the minimum variation trend. It hardly even fluctuates. There's hardly any heartbeat. You can't see the minor supercycles. And we just see this continually sustainable. You can see the 2009 financial crisis in this chart. It did make a big enough impression, at least make a blip on this chart. But for the moment, this is still trending higher. So what do we do for timing? Well, we know the 216-year bottom was in the 1930s. The next bottom isn't even due to like the 2140s or something like that. How about calculating peaks? How long would this economic boom last according to nominal GDP per capita? Well, the answer is that if we calculate the 54-year cycles, there should be 4 of them. And as we look at greater detail on a shorter term basis, we find that there probably was a top somewheres in the 1980s, maybe 70s. You can make a variety of arguments. But what we're coming up with is the next 54-year top would actually be due in the 2030s. And that fits well with what we've been saying with the super cycles for the markets like stocks and commodities, that we're actually in a 100-year bull market. We're not in a 100-year bear market like some of the doomer gloomers and the mega bears and the perma bears keep forecasting. That indeed the economy is going to continue to grow all the way to the 2030s. Then maybe we can have a problem, and my guess is all that problem is going to be is a slower paced growth for the next 100 years or something like that. So a rather fascinating structure to just looking at some of our history, what really occurred, and what is occurring now is that we are in some kind of 100-year bull market within that is the upside or uptrend of a 216-year cycle, and that cycle can be used for peaks as well as for bottoms. Now this next indicator I'm showing you is an invention of my own. It's a summary of the ISM Manufacturing Index, or they call it the PMI, the Procurement Manufacturing. There's 2 types. There's another one made by market. But for many years I've used the ISM PMI as a great indicator of what the economy is doing. In the past in 2012, I felt it slipped for the first time in decades that I've followed it. But for the most part, it does a pretty good job. Well, what I've done is by making a cumulative study, meaning if the PMI is 50 or better, we add it. If it's below 50, we subtract. And the reason is they assume that at 50 or better, the economy is growing, but under 50, the economy is actually contracting. And you don't get a recession until you get down to about 45, 42, which is what occurred in 2009. That latter statement was my own personal opinion on how to use the PMI. At any rate, this only goes back to 1950s, but what I found is there's a pretty good correlation with GDP, and with this particular indicator, which I call the eco trend, we actually wind up with a pretty good correlation in nominal GDP per capita. So it allows us to get a little bit different viewpoint, but similar viewpoint. It allows us to have a little greater detail to what's going on, since it's a monthly number that's actually published, so we can look at something more short term. What I've learned is that the eco trend indicator, by doing that summary, that cumulative study, it reduces some of the smaller cycles, like 3-year cycles or smaller. And so some people would say it's filtering out noise, but none of it's really noise. But by filtering it, we wind up at a little bit different viewpoint, and we can focus more on long term. And what I want to point out is this indicator will bottom about every 8 to 13 years. It'll peak about every 8 to 13 years. It has an uptrend lasting about 7 to 12 years, a downtrend lasting 1 to 3 years, and when a recession will occur. We normally get what I call a primary recession once a decade. Every decade there's a recession. Sometimes there's 2. There's also something called a secondary recession that normally is not classified as a recession by economists. What I've learned then is that that pattern matches up with this cycle, and this is reflecting a net growth trend, a growing, expanding economy. And it says the economy grows for 7 to 12 years. What I wanted to point out is, more than likely during the 2000s, when we peaked out and went into the financial crisis, the Great Recession, we likely peaked out for a 27-year supercycle for the economy, We peaked out for some commodities. And the stock market, it doesn't use a 27-year cycle. It's more like a 36 and 72. But the stock market at least fell into a 72-year cycle bottom in 2009. So we see these cycles lining up with our thinking that there was probably a 27-year cycle correction going into that Great Recession, and it may very well dropped into a 72-year cycle bottom. Even if you discount all that, what you would come up with is at least that 9-year cycle bottomed in 2009, and we were able to time it within a month for the PMI using cyclical patterns. Using that, the forecast now suggests that the trend should be up for the Eco Trend Indicator, suggesting net growth for the economy due to the fact that the PMI will spend most of its time over 50. And it will maintain this trend to about 2019, which is the earliest we see for the next decadal recession. So we believe we're in a net growth trend for this decade. We believe following a recession, next decade will be even better net growth. And then there will be another recession, and then there will be still additional net growth in the 2030s, but we're going to probably see high inflation. We're probably going to run into a burnout phase of this entire trend and a peak of this entire 100-year bull market all the way back to the 1930s. Even if you don't buy into any of this, you ought to consider this 9-year cycle, bottom to bottom, top to top, and consider that it's suggesting the economy can grow to 2019. And look at this Eco Trend Indicator. It's already at new highs compared to the high before the 2008-9 Great Recession. My guess is when we update nominal GDP per capita, we're also going to learn we've got new record highs in nominal GDP per capita. The economy is growing. It's bigger than ever. It's just that the mechanics inside the economy are not working as well as they used to, and we're still running with rather high unemployment and a slower growth than what we're used to. But indeed, we're still growing. The economy is still moving forward. And if anything, by next decade, we're going to see a speed up phase. Thank you.